All right, welcome in everyone. Thanks so much for joining us. My name is Albert Marquez. I'm joined by my friend and colleague, Mr. Andrew McGowan. We are part of the trading strategy desk here at Fidelity, a small group of market technicians and traders whose goal is to educate and hopefully facilitate your trading process. We've made it to week 4 of our options 4-week classroom options for beginners 4-week classroom session. This one is going to be focusing on options trade management. So hopefully over the course of the last several weeks, you've been able to follow along and you feel more comfortable with your options knowledge. Again, we're not assessing that you're going to be you know experts by the time we're done with these 4 weeks, but what we're hoping is that you do get a better understanding of options and maybe how they might potentially fit into your trading plan, or maybe you're already trading options, you just want to get a little more information. Either way, we're glad you're here and we hope that you're getting what you need. If you're not, please let us know. We absolutely want to answer your questions and make this as useful to you as possible. So don't be shy. Let us know. We will happily answer those questions for you. Before we jump into it, a couple of things I want to point out, of course, from our main webpage, News and Research Learn brings you to this page right here. On the left-hand side, we have some icons. The fourth one, events. A couple of things I want to point out. First and foremost, Trading Strategy Desk coaching. This is a direct link to our landing spot for Trading Strategy Desk. And we have a variety of sessions that we run, 6 or 7 a day, on a variety of topics. But the nice part about this is it's broken down by topic. So after today, you want to look at something more options related, you can hit find a session and it's going to list out for you option related sessions that we do have coming up. You'll notice that the first one, of course, is what we're doing right now, options trade management. One I do want to point out, I think would be very useful if you have the ability to follow up. That is the 7 option trading mistakes to avoid. This is a great session about simple things to think about when you are trading options, mistakes that I know I can raise my hand for probably all 7 of them, Andrew. I'm guessing you probably could do the same. But the nice part is we've kind of put them down and thought about them, and hopefully can help you to avoid paying that same tuition that we had to pay learning those lessons. So if you have the ability, that's going to be tomorrow at noon Eastern Time. 7 option trading mistakes to avoid. If I go back to this page, and I'm going to go back to the events tab one more time. This time I'm going to go to Trading Strategies classes. And of course, this is going to be a breakdown of the different sessions that we offer. We are options for beginners, learn more and register right here. We also have options intermediate. If you went through these 4 weeks and you feel like you've got a pretty good handle on things and you want to learn a bit more, we'll step into some more detailed discussions about options, including volatility, spreads, Greeks, things of that nature. So if you want to join us, feel free to join us for that. Absolutely. We've got other ones too, Trader Plus, technical analysis, trading basics. But if I hit learn more and register, That's going to bring me to this March classroom that we are doing right now. A couple things here. You'll notice that these three links are to the homework, so we will touch on that here shortly. Also, download the slides. If you want to follow along, here are the slides for you right here on this link, so feel free to grab those and follow along. The other thing I want to point out before I switch over here is we're going to do this again in April. So if you went through it and you thought, yeah, feel pretty good, but I'd certainly like to learn a little bit more, maybe go through it one more time. We do have it available in April. It's going to start on April 1st. That is no joke, folks. And we will go through the same 4-week progression, the same topics. So please, if you feel like you need a little bit more, we'd love to have you back. Otherwise, if you click Learn More and Register, this gives you the breakdown of the different sessions that we had over the last 4 weeks. Of course, we started to intro to options, all the basics. We went to buying options, selling options last week. And of course, today we're on options. We've got some homework to talk about. So, Andrew, great to see you as always. I'm going to let you take it away for that homework.
Hey, likewise, happy to be back with everyone for now week 4. Very fun 4 weeks we've spent together taking a look at all of these different components. As Albert mentioned, as much as we would like a 4-week class to be everything that is known throughout the universe of options trading, unfortunately, there is so much still to learn. This is the basics of options. There's still so much to expand upon, and that might mean re-attending this exact same class to reiterate a few different things that you learned throughout these 4 weeks. That might be segueing into the options intermediate class. That might just be looking at our one-off sessions for options trading. That also might mean maybe combining this with other types of learning, technical analysis, the Fidelity Trader Plus classroom. So keep in mind our team at fidelity.com/coaching. Nonetheless, I want to take a look, as Alper mentioned, at last week's homework. To reiterate, you can get both of the important links for today on that classroom's landing page. The homework itself, week 1, 2, and 3 links that you'll see here. We will look at, of course, week 3's homework, and the slide deck that we will be using for today's session is a download slides deck here. So without further ado, let's take a look at last week's homework. That being said, if you were able to complete last week's homework, if you don't mind hitting the raise hand tool, just so we can get a general gauge. All right, seeing some hands fly up already. So we'll go through these fairly quickly so we can spend as much time on the actual content of today's lesson. But first and foremost, what does this profit and loss diagram represent? So let's dissect it. It looks like this one has profit being this axis that we see here, and the price of the stock seeing the axis here. It looks like this one is profitable for us as long as the stock is above somewhere between $94 and $95, and it caps out our profit at $100. So what does that mean for us? Well, after it gets above a certain point, it's no longer profitable for us. After it gets above $100 per share, it is no longer profitable for us. And then as long as it stays above $94, $95, it is okay profitability for us. But anything below that is not profitable. It's working against us. And in fact, this is theoretically moving to the left in that unprofitable capital loss perspective, all the way down to the theoretical limit as far as how low a stock can go, and that is $0 per share. What is going to be the correct answer? If you said cash secure put, you would be correct. However, if you said covered call, you would also be correct. So the correct letter is actually both B and C. So remember, a covered call essentially allows us to sell away the upside to someone else, to sell away a call contract that gives someone else the right to buy our shares at that strike price. We receive a premium for this. So for this one, as well as for the put itself, this would be representative of that being above $100 per share. Next one then. What does this below profit and loss diagram present? So what does this one look differently for us? Well, for this one, as long as it stays below $100, we are profitable. In that case, it starts to hurt us anything above $100 per share. We break even at a 103 or so, and then theoretically an unlimited risk to us as it continues upside in the stock. Which one is that going to be? It is a short call. So remember, that is somewhat different with a short call versus a short put, is that if the only thing we have is a short call, unencumbered by shares, that's what differentiates a short call from a covered call, is that we don't have the share deliverable already in our account. What is essentially called a naked call, this short call, there is no theoretical maximum to how high a stock can go. We can think about things through the lens of probability that this stock trading for 50 bucks, could it go to $5,000 per share? Probably not. Probably it's not going to happen. But is it impossible? No, it is not mathematically impossible. So we have to think about the risk on a naked call, a short call, as theoretically being unlimited. Again, you could say that likelihoods and possibilities versus probabilities are a natural, fair argument to be found. But possibilities are the word that we have to work within this at least example, and possibly speaking, it has an unlimited risk to the upside. Next one, when a short call is assigned, what happens in the account? So remember, if you are someone who's long the call, what do you have the right to do? You have the right to buy the shares. What is the inverse of the right to buy the shares? It's the obligation to have to sell the shares. So we know it's either B or D. Sell 100 shares at the strike price or sell 100 shares at the strike price plus the premium. If you remember from the prior week's homework, the premium is a very important component to the totality of gains or losses and the cost base event takes place. The premium is unimportant. It does not factor into the actual assignment. So logistically speaking, the only thing that happens when assigned on a short call is that you sell 100 shares at that strike price. That's all that you will see in your history and activity in the account. It'll say, short call assigned, sold shares at this strike price. And that's all that you will see. Now, when you factor in again your total gains and your total losses and your net premiums and things of that extent, of course, what you were paid for, that is important, but it does not factor into the actual logistics of assignment. Same question here when a short put is assigned, what occurs in the account? What is the occurrence of a long put being exercised? It's the right to sell the shares. So what is the inverse of that? The obligation to buy the shares. So we know it's either A or B, buy 100 shares at the strike price with the premium, or buy 100 shares at the strike price. Same sort of answer as we just had. It is strictly just thinking about the logistics of assignment, which is buying 100 shares at that strike price. Next one, what option strategies would benefit with an increase of the underlying security? So in essence, which of these strategies are bullish? Let me see if I still have this slide deck up, because I always think it's so fun to bring us back to week one's quadrant chart of sorts. Which ones are bullish? Well, remember long call. That one's very simple to understand as being a bullish, that you buy the right to buy the shares, and if it goes up higher, then you benefit from that. A short put is also going to be the correct answer here. So we have long call and short put being bullish. Why is a short put bullish? Well, if you have sold the obligation to buy the shares, sold someone else the right to sell the shares, sold the obligation to have to buy the shares, well, yeah, you want it to go up. You don't need it to go up exponentially like you need on a long call, where a long call specifically unlimitedly benefits from upside. A short put just simply benefits from the stock not going down. So that's the fun differentiator, is that if you have a long call, you need the stock to go up. If you have a short put, you just need the stock to not go down. How is that different? Well, sideways price action also helps a short options trade. If simply nothing happens and there's a neutral sort of move in the underlying, that can be beneficial. But because bearishness, because downside is the thing that hurts us, it's inherently a bullish trade. So the correct answer here is going to be long call and short put. If I was looking to sell a put to initiate a position in account, what action would I choose? So we know it's selling a put, so it's got to be one of these two. Sell to open or sell to close. What differentiates to open versus to close? This phrase here, to initiate a position in my account. I am opening a new position, so I'm selling to open that position. Next one, if I was looking to close out of a long call that I already had in my account, which one would I do? Well, we know it said close, so it's got to be buy to close or sell to close. If I have a long call, what was the original trade I put on? I bought that call. Let's see if it says this on this quadrant here. Yeah, so you buy the long call, you're long the call, you have bought it. What is the opposite of buying something? It's selling it. So if you have bought a long call to close that position out, you would sell to close. To open it, you would buy to open. To close it, you would sell to close. Well, next similar question that we have here, if I was looking to close out of a short put that was already in my account, what action would I choose? So originally, if we had a short put, remember this short put here, we had this component, short the put. What did we do originally? We sold to open that put. That was this question here. Sell to open, sell a put, short a put. What is the opposite of selling to open? Is going to be buying to close. You have to buy that put back from the marketplace that closes that position in your account. Next, what is the break-even price for an SPX 3250 put that you sold for $50? Quite a bit of ways from where we're at currently in the SPX. So that short put that you had sold hopefully worked out for you. But what's the actual component here? Well, if you were obligated to have to buy the index at 3250 if assigned, but you got $50 for that, technically your break even is 3,200. Anything below 3,200 is a loss for you. You have to buy it at 3,250. Say it's at 3,150, you've lost $100 per contract, but you took in $50 originally. 50 is where that break even price is subtracted from. So 3,200 is the break even price. Anything above 3,200 is profitable, or maybe not quite profitable, but not a total loss. And then anything below that is going to be a loss for us. Last question. What two option strategies are synthetically the same risk and reward question that we went over? How we mentioned that these two on a profit and loss diagram look effectively the same. Cover calls and cash secured puts. The reason that is the case is that they are what is called synthetically similar, synthetically equal, synthetically comparable strategies. They are very similar in their approach. So always keep that in mind. If you've ever told yourself, I like covered calls, but I don't like cash secured puts, at the end of the day, they are very, very similar strategies. You are capping your upside potential. You are retaining substantial downside risk. There's contextual moments in time of one versus the other, but ultimately they're very, very similar in their approach. Two sides of the same coin, effectively. We'll skip the project so we can spend as much time on the bulk of the day's session. Anything you wanted to add, Albert, before we dive in, though?
Yeah, I just hope everybody's starting to feel more comfortable with this. And let us know, obviously, in the question and answer. Let us know how you're feeling. If you plan on, maybe retaking this, if you plan on moving on to the next thing, or just in general, what your thoughts are about the are over the last 3 weeks, and of course today. We'd love to hear your feedback. But that being said, let's get into what it is that we want to talk about, and that is, of course, managing our trade. So we've went through the process. We now understand the basics of the option, and now we're thinking about, okay, we've got our trade on, whether we bought or sold, doesn't matter. We have to manage the position. So how are we going to do that? So we're going to talk about, of course, managing prior to expiration. We'll talk about managing at expiration, and of course, position management. So let's start. We've got our position on. We're not quite at expiration. What do we do here? Well, the first thing that we have to think about is, do you still have the same outlook? So we got to think about our outlook. We started off with some thought process, whether it be, we think the stock is going up, we think the stock is going down, whatever it may be. But we had some sort of outlook that framed this trade that we have put on. So the question is, well, do we still have the same outlook? Has the stock moved up already more than we thought it was going to? Does that change our outlook? Has the stock maybe kind of just sat around and done nothing? Has it gone the opposite direction? We have to determine if we have that same outlook or if that outlook has changed at all. And therefore, we have to be maybe thinking about, do we still have the right trade on? If the outlook is different from when we initiated the trade might need to be a different trade. And that can go either way when it's going for you or even against you. If it's going very well for you, maybe it's a time to take some money off the table and maybe take the trade off and put on a different trade that still gives you that kind of access, but taking in some of the profits. On the other hand, if we are maybe on the opposite direction, we are losing some money, maybe that's the time to do that and take that trade off. Either way, we're going to take a look and make sure that our outlook and trade are still matching up. Again, were you bullish? Now you're neutral, bearish? Has the time horizon changed? These are important questions to ask, because remember, the price of the option, the premium that we see, it's going to be affected by not just the movement of the underlying, but also by the change in time and the change in those volatility levels. So any of those things can be different, and that could alter your outlook. And of course, here's an important point, right? Be honest with yourself when reevaluating the existing trade. You know, the biggest problem I think a lot of people have, a lot of myself included, is that we just want to think about the good side, right? We want to think about, hey, if I'm right and this does what I think it's going to do, then I'm going to make this amount of money. But the reality is, if you want to be an effective trader, especially an effective options trading, you might as well check your ego at the door because the market does not care how much time and effort you put into your analysis. It's going to do what it wants to do. And think about it, baseball. Hall of Fame baseball players get 3 hits at every 10 at bats. Now we're hoping to be a little bit better than that, but the point is we're going to be wrong from time to time, and that's okay. But as long as we're honest with ourselves and don't get ourselves stuck into a situation where we're trying to adjust a losing trade just to avoid that loss. Sometimes we have to step back and say, I was wrong. Let me take this off and reevaluate. That's what we call paying tuition. The goal is to pay tuition and not take the class over again, as always, right? So learn the lesson and move on as opposed to torturing yourself. I always tell my kids, we can't choose to not feel pain, but we can certainly choose not to suffer. And that is an important point when you're trading, especially options. If you're wrong, you're wrong. Hey, it's going to happen. Let's maybe make sure that we're doing the right thing. And of course, make sure that we're making adjustments, any adjustments that we're making for the right reasons, and think about the end objective of the trade. We don't want to just kick the can down the road, so to speak, and try to sell something to recoup what we've already lost. That just ties us in even longer and makes maybe even a worse situation. So let's revisit what factors affect the premium. Well, of course, the moneyness. And again, this is getting back into that strike selection. Out of the money options offer lower premiums, lower probability. At the money options has the most time value for your particular trade. And again, we can think about this from the context of the underlying and the strike price. It's that intrinsic value, right? Simple math equation. Is it in the money? Is it out of the money? And if that is the case, then how do we think about these types of trades? Do we want something that maybe is out of the money and is solely made of extrinsic value? Well, if we have an outlook that matches that type of trade, then yeah, that could be the right trade. On the other hand, if we have a situation that's maybe playing out over a longer time period, then that time factor becomes a bit more important to think about. Which leads me to timed expiration and that expiration selection. You know, the nearer term expirations, Constantine always likes to say, if you're dealing with the nearer term or short term expirations, you're swimming in the deep end of the pool. And that's absolutely correct because the way that short term expiration options work or respond to markets is a lot different than longer term expirations. As you can see, the longer date expirations decay at a slower rate, but they have higher premiums. So that means you're paying more time value, but you're given a little bit of a relief on the as far as the decay goes. On the other hand, nearer term expirations, you will pay less premium, but now you're exposed to that time decay. And so you have to, again, balance out what it is that you think is the outlook. How is this going to play out? What's that time frame look like? And what is the right trade for that particular situation? So, as always, right, we're talking about the three factors that affect premium. It's the underlying, of course, right? The strike selection and the underlying movement of the underlying. It's that time to expiration. And of course, the third one is what? The volatility. If we're dealing with an option trade and we've got higher implied volatility, which means, we expect more movement, that's going to have a higher premium. Now, that doesn't mean that because volatility is high, it cannot go higher. I think we could probably see that over the last few weeks. But the thing is that in certain scenarios, we have to understand that volatility as a theory or in general is a mean reverting type of idea. So if we think about times when volatility is higher, the natural thought is that at some point it's going to move back down. Now, the question is, does it move higher before that point? That's the real issue. Now, this often comes into play during certain scenarios, and I'm sure you remember when we talked about this throughout the course of the last 3 weeks, but we're talking about earnings, right? And oftentimes we'll see volatility move up in anticipation of earnings, and to do what after the earnings come out? Drop off quite a bit. So if we're paying higher levels of volatility for a call because we think earnings are going to be great, well, guess what? The earnings could be great. The stock could move up, and that call could lose money because of the movement and volatility. So keep an eye on that and be aware that that is a major impact. And quite honestly, I think, in my opinion, it's the most important point of trading options because that implied volatility is a very dynamic aspect of option pricing. It's going to change not just day to day, but potentially minute by minute, hour by hour. And that's an important factor to think about when you're trading options. Of course, lower implied volatility results in lower premiums. But again, if we're talking about a lower volatility, what are we talking about? We're talking expected a lower expected price movement, and therefore, do we actually get the movement we need to make that option pay off? We'll have to think about that. So, three factors that affect the premium of an option, three things that we need to constantly be thinking about with our option trades. Some more than other. If we're trading longer term, we can maybe not think about this as much, but we're still going to be affected by these two. So there's always a give and take when we think about these three different components. Make sure that we understand what they mean and how we're going to incorporate that into our own outlook and our trading plan. Now, if we want to think about the three ways to manage the strategy, and the first is we can leave the strategy alone. Let's say you went through that process of going over your outlook, and honestly, your outlook is the same. Things are working out as you had expected. And if you were to ask the question, would you put the same trade on today? Your answer is yes. Yes, I would. I think this is the right trade to have on. So you could leave it alone. You could let it ride to the exercise or assignment. You can continue to stay in the trade. The one thing I will mention here, and as I like to give out some public service announcements. So my first PSA is this. If you're doing what you think it's supposed to do, make sure that your account can support the exercise of that option. So for example, let's say you've got, a Tesla call on that's doing quite well and it's in the money and you're feeling great. Well, if you don't have enough cash to support buying the 100 shares of Tesla, then you're going to have to make some decisions as it gets closer to expiration. What are you going to do about that position? And the reason I mention this is because Fidelity can and will go in to your account and sell that option out if you can't support the trade. So if you have plans for that trade, if you're trying to watch it and sell it out before it expires, make sure you give our service team a call and let them know what your plans are. Otherwise, you may not be able to choose when you sell that position. So that's my first public service announcement for the day. Make sure you can support the trade if you're going to leave the strategy on. The next is close the strategy. And I don't remember the exact number. It's pretty high, right, Andrew? It's like 90% or something like that. But 90% of strategies, options get closed out prior to expiration. They do what they want to do, they take the trade off. Or the strategy no longer aligns with the outlook, right? You've gone back and said, I don't really think this is what I expect to happen. I'm going to go ahead and close this out, whether it be good or bad, and be done with the trade. The other part about this is, you know, if you put on a trade, let's say you sold a put, for example, a cash secured put, and you sold it for $5, and you're hoping, of course, to make $5 on that trade. But what if we get to a point where maybe we're a few weeks out from expiration and that option is worth 50 cents? Does that change your opinion at all? A lot of traders it will. If they get to a point where they make 85, 90, whatever percentage of the overall expected profit, that's going to be enough for them because what are they effectively doing? Well, a lot of people say risk management. I like to call it reward management. You were right. You've made a lot of money on the particular trade. Nothing that says it's going to continue to go that direction. You absolutely could give back the money you made. So the decision is, do you want to take some chips off the table and reward yourself with that good trade, or do you want to squeeze it for the end to get that last 15, 10% reward that you thought you had coming to you? And I only mention this because I've done that before. I've had that situation where I had a call spread on that was 50 cents away from being fully in the money on the day of expiration. And I said, you know what? I deserve this 50 cents. I'm going to hang on to this thing and let it ride. I went out to lunch with some friends. I even bought lunch because I was, a high roller at that time. Came back to a tape bomb and the whole thing reversed. Not only did I not make that extra 50 cents, I lost everything in the trade just because I was trying to squeeze it for that last extra. So remember I talked about that class coming up, 7 option mistakes? That's one of them. Think about the end result. Think about what it is that you're doing. Think about what you already accomplished, and then maybe consider, is it time to maybe close out that strategy? And that could be dynamic too, right? It might be your number is 85, 90%, but But if you wake up tomorrow and it trades up 50%, is that enough? So again, this goes back to the idea of reassessing the outlook, but there might be a time to close out the strategy ahead of time to do some proper reward management. And of course, the last one is adjust the strategy. Again, this is an existing strategy, can be altered because your outlook has changed. You thought of something, and maybe again, this is something that has changed slightly, and you want to adjust the position. Maybe you need more time, or maybe it's gone so well that again, you want to maybe thinking about closing out the strategy. But what about instead of closing it out, you close out the current one and put it back on in a different strike, and maybe take some of the profits you made and just kind of put them off to the side. You can absolutely do that. I guess the point I want to make here is that if we are adjusting the strategy, and again, absolutely can do that. But make sure that when we do adjust a strategy, we're doing it for the right reasons. We're doing it because we were correct and we've made some money and we want to, again, take some of that money off the table. Maybe we're doing it because we think we need more time, so we're rolling it out. Those are good reasons. A bad reason is I'm down 50% on this thing. I'm going to roll this out and sell another one just so I can try to recoup that. You're only going to lock yourself into that same trade for even longer period of time. And again, it's important to sometimes assess, hey, is this the right trade to begin with? And maybe you did some analysis that just wasn't good, right? Maybe you've got a bad trade on. And if you've got a bad trade on, sometimes it's better just to let it ride and pay that tuition and not continue to stay on and punish yourself with a bad trade. So if you're going to adjust the strategy, make sure you're doing it for the right reason. That's really the bottom line here. Okay, so I've been going on for a while here, Andrew. Anything you want to add to any of the points that we've made so far before we move on?
Yeah, there's a few questions that any sort of options management. The thing that I just can't emphasize enough, and I think it's such a valuable lesson for us all to think about, not just within options trading, but really just within all trading entirely, is that anytime we have a position on, it's easy to find ourselves in what's called the disposition effect or a bias of sorts, that we act as if closing the position is the only choice, that we either have the position or we close the position. And I want to emphasize enough that every single day that we have a position in our account, options, stocks, ETFs, anything, it is an active choice to keep that position on. Effectively, it's the same process, the same logistics of if every morning you had to place a trade to open up that trade, that's what having that position on is. It is an active choice to continue to have that. So the question that I just always encourage us to ask ourselves is that if you did not have the position you currently have on, would you initiate it today? Would you initiate it if it wasn't already in your account? If the answer is no, that might be a good enough gut check to change up that position to some degree. It doesn't mean having to be all or none in that sense. It could be maybe editing some of it. Imagine if you were saying that, hey, I've got this long call on, I bought 5 of them, and they've done fairly well. Would you execute 5 of them today? Maybe you'd only execute two, and now you have somewhat of a permission structure to sell three, to get to close three, because it's easy to get lost in a position that is just in our account and we act as if it was kind of inherited, that we were just given this position out of nowhere, but it was a choice. And then we always have this choice at all moments and times. And that, I think, even more so is found when we're, say, short an option. That imagine you have a cash secured put, let's say, that you sold originally for, let's say, $5, and now it's going for 50 cents. And you're thinking, well, hey, I still, as Albert was mentioning, I feel like I'm owed that 50 cents. I could get that 50 cents. But the question to ask yourself is, if you didn't have that position on, would you sell it right now? Would you open that cash secure put for 50 cents? You might be thinking, well, hey, 50 cents isn't worth the juice for the squeeze of the risk for this position anymore. I don't get why anyone would open the position for 50 cents. And again, that's what you have effectively chosen to do. You've effectively chosen to open it at 50 cents by keeping that position on at that level. So at any moment in time, this slide is so impactful in the sense that we can do three things at all moments. We can either do nothing, we can do everything, where we either leave it all alone or close it entirely, or we can do a little bit. We can adjust it, we can change it, we can roll it, we can do things to that extent. This next few slides, we talk about early exercise in the last few sessions. I would just say, generally speaking, it is not generally going to make sense to ever early exercise an option. Why? Well, assuming there's any amount of time value left in the position, well, it just doesn't make sense then to early exercise a position that has any amount of time value, generally speaking. And I know this, I keep saying generally because it is contextual. It is going to be dependent upon the exact moment in time that we might be looking at. But, let's go to a quick example on our Fidelity Trader Plus to look at an actual option chain. Let's just imagine we're trading, let's just say Apple for sake of comparison. Most people, maybe you've never heard of Apple. They're a very unknown company in that sense, but maybe you're just thinking, well, hey, I've got this April 17th call. Let's say we go out a handful of strikes. Let's say that you were very ahead of the time and you bought this 225 strike call. Well, you might be saying 225, it's deep in the money, it's trading pretty intrinsically, but you'll notice it still actually has $2 of time value. What do I mean by that? Apple's going for just shy of 251. This is a 225 strike call. It should be worth $26, give or take intrinsically, but it's worth about $28. So right this moment, if you told me, well, hey, I want 100 shares of Apple. I bought the right to buy the 100 shares, to exercise my right to buy the 100 shares at 225. I want 100 shares. I don't care if there's $2 of time value. Well, what could you do instead? You could simply just go out to the open market, buy 100 shares of Apple, and sell to close this contract and keep your $2. That's why it generally does not make sense to exercise early, because assuming there is a liquid enough market for you to be able to just simply take action on the individual options themselves, you can roundabout your way into the exercise of the option by just taking market action. Instead of exercising the right to buy the shares at 225, you can just buy close this call contract, keep those $2 in your pocket. Where does it stop making sense? Well, you'll see as we go further and further down the line, that time value really begins to erode. So that 110 strike for April, 50 cents of time value. And once you see here, there's like $2 or so of spread in the options bid and ask. So that might be less liquid, but we might have a harder time actually getting the actual value out of it. Or imagine a scenario that instead of the April 17th, we're looking at this Friday's expiration of March 27th. And now these have 4 cents of time value and a $3 wide spread. That's where you might want to consider exercise just to make sure that you don't end up losing unnecessarily. Imagine a scenario where you say, hey, I've got the 110. They should be worth what? $141 or so, and you sell them in the open market and you only get 140. You just lost $1 of time value, or lost $1 of intrinsic value rather. So in that case, that's when exercise starts to become an important distinction. So then if we know that about exercise, we can apply the same general thought process to assignment of what is the likelihood of assignment at any moment in time. If you were someone who was, say, instead of long, you were short the 250s, well, hey, those 250s are in the money. They have $1 of intrinsic value, but they're going for $8. Someone deciding to exercise that 250 would just be giving up $7 for no reason. If that happened to you, you'd almost be ecstatic, because if that was the case, you could close the shares that you were assigned and you could just reopen that position. And now you're $7 richer for no reason except for the other person's silliness of deciding to exercise it then. Does that change their right to be able to exercise it? It does not. That's the thing you have to remember the most, is that they have the right to exercise their contract regardless if it makes sense or not. So that is the thing that you have to remember if you are ever going to be short options trader, is that you don't have the control over whether or not assignment takes place. It is up to the person who is on the other side of that. To lower your risk of assignment, the thing that you want to more often try to do is to not have something that is lower and lower in time value, because then you might run into that scenario that someone says, well, hey, it's not that big of a deal. Imagine instead of that, you were short something along this end and they said, all right, 40 cents doesn't matter that much. If the spread's $3, I'll just exercise it. That doesn't matter that much to them, because in that case, they're thinking more about capturing the real value than they are pennies on that intrinsic or time value perspective. Especially something to consider. I don't know if we have it notated here. I was going to look for a dividend date. Ex-dividend. If an underlying is about to go ex-dividend, that is going to inherently increase the likelihood of a options assignment, because the person who's long that call if it has any sort of value to it, they might say, well, if I exercise this, I'll get the dividend that offsets some of those premium components that we were just discussing. So being very readily apparent and up to date on any sort of upcoming dividend is going to be an important distinction as well. Now, what are some other ways that we can manage a position? Well, imagine a scenario where you decide we're not going to leave the strategy alone and we're not going to close the strategy, we're going to adjust it. What does that mean? Adjusting it can mean a variety of different things. As mentioned earlier, it could just mean maybe you had 5 contracts and you close a couple of them, and now you have 2 or 3. Rolling it, though, is a way of adjusting the option to some degree, but keeping the general outlook intact. There's kind of 2 main ways of rolling it, and there's by all means, a combination of it. One, you could just roll it out further in time. So imagine originally this underlying, you sold the 120 strike call, let's say as a covered call for December's expiration. And you say, well, hey, it's at 118.23, it looks like on this screenshot. It's getting close to 120. It's getting closer to the likelihood of being assigned. You don't want it to be assigned, but you still think it's not going to get above 120. And you say, well, maybe I just go ahead and close this position and I push it out to January's expiration. That is considered rolling the option out. That is, in this case, buying to close the 120 strike. It looks like for roughly 90 cents or so, selling to open the 120 for January instead. And we're effectively just pushing out the potential of this expiration and assignment therein. The most important thing I always like to emphasize on rolling, a lot of traders who start their options trading journey being very covered call centric, where that's the thing that you heard about, that you had these shares, you can start selling calls against this, and you get sold the unfortunate bill of goods of it being income or yield or rent on your stock or something like that. And you sometimes the market does move up higher than the market was anticipating. And now all of a sudden you've got an in the money contract that you don't want to sell the shares of. And what do some traders do? They decide to roll it. Is that inherently a bad thing? Maybe not. I think it really just comes down to, does it match your outlook? Where do I think a lot of traders get in trouble though? I think a lot of traders mistake rolling for just truly kicking the can down the road, where we simply just push it out because we don't like what it is currently doing. And we think, all right, if I give it 4 more weeks or 6 more weeks, everything will work out fine. But what's the issue of, imagine a scenario where you rolled this out because you didn't like how close it was to 120, and then by January it's at 130. In that case, would you have been better off just closing this 120 strike and keeping the upside in your shares had we had a crystal ball that's told us the shares were going to be worth 130? Unfortunately, we don't have a crystal ball. We just have to make decisions based off our outlook. But that's the thing to keep in mind, is that sometimes spoken to traders over many years that they just kept rolling it. And now this call contracts, $100 in the money, and they effectively have closed their shares. They just keep rolling, thinking that they will be able to negate it over the time. The joke I always tend to make in scenarios like this is that I always say that the term roll sounds like it was made up by some sort of advisor in like the 90s or 2000s to explain away a bad trade, that says that, hey, we're not going to close this whole position out at a loss. We're going to roll it. We're going to just roll it. It's fine. And that's the thing I just always want to emphasize, is that if you're rolling a position, logistically, what you are doing is you are closing out the old position and opening up a new one. If doing that makes sense to you, then that's fine. If you say that I need to close out of this one, I need to open a new one because that's what fits my outlook currently, totally fine. Rolling is going to be a way of executing that trade in a single capacity, because the purpose of a roll to me originally is it's one trade. It is buying to close one option, or selling to close, essentially closing one option and opening up another one, hopefully to be executed at that exact same price. That is what we are trying to do. That is logistics of that, is that we are doing that to have it executed at one fell swoop, because the alternative, imagine a scenario where you buy to close the 120 strike with the intention of, the moment it fills, you go in to sell to open the new one. And in those few seconds between those trades being executed, the stock craters. Now, all of a sudden, that entire outlook might have changed for you. So the purpose of a roll ticket to me is really just that it is a one entry, one exit sort of trade that is simultaneously executing both if the limit price is hit for them. Now, what's the other type of roll? Maybe we decide to not just roll it out, or maybe we decide to roll it up. In the same scenario where maybe you're thinking, well, hey, I still think it's not going to have anything happen between now and December, but I have the 115s, it's at 118, I want to move it to the 120s. In that case, you're rolling it up, but the main thing to always keep in mind is that, again, it needs to match our outlook. That's the most important thing, is that we want to make sure that we're having that gut check, again, asking ourselves, if I did not have this position on now, would I execute it? Would I open this position today? Now, managing things at expiration, usually pretty simple, because at expiration, the stock is either going to, or the option is either going to expire worthless or get exercised or assigned. That's the fun binary, is that it's either in the money or it's not. Which one do you prefer? Do you want it to be exercised? Do you want it to be assigned? Do you want it to close? Now, to emphasize option one here, no pun intended, is that up to the market close of the day of expiration, you can close the trade. Remember that a lot of options don't actually go through exercise and assignment for retail traders, because unless you actually want the shares, theoretically speaking, you could just close the position and take whatever profits that you had on it. So always keep in mind is that up to the actual expiration itself, you can always just close the trade. As long as it has not been assigned already, you can just close the trade. Now, if you do want it to go through the actual expiry cycle, what actually happens? Well, if the option is 1 penny or more in the money, it is assumptive that it is, of course, now in the money and you want it to be exercised. There's a caveat, especially at Fidelity and probably other brokers, is that if you have, an inordinate amount of an option that the exercise itself will overbuy your account, there's probably some nuance on whether our risk teams will allow that options to go through. In that case, it might automatically be closed out on behalf of the risk team. So keep that in mind as well. But generally speaking, if it is a penny or more in the money, it is assumptive that you are telling us that you want it to be exercised, and that automatic exercise will occur in the account. Same thing on the other short end. So always a rough learning experience for anyone who has it. Imagine a scenario where you have sold a covered call, let's say, for $100 per share, and the stock expires at 99, or it closes at 99 the day of expiration. You're thinking, all right, I'm good. It closed at 99. I had the 100 that expired worthless. And then you wake up Monday morning, you got a sign, and you're thinking, how could that possibly be the case? Because it closed at 99. Unfortunately, to keep in mind at all points in time, I've emphasized this a few times. The person who is long that option, they have the right to exercise that contract, whether or not it makes sense to. Why might they have decided to exercise a option to buy the shares at 100 when it was at 99 and they close? Imagine that company announced something cool and great right after hours on Friday afternoon. The stock shoots up to 102 in the after hours. Now that makes sense for them to exercise. They generally only have like an hour or so after the market closes to call their broker and say, hey, I know this expired worthless, but I want to exercise it anyway. But they do have that right. So always keep that in mind. And again, that goes back to that example Albert gave of going into the end of the day there, that option was probably only going for a couple pennies. Yes, you could have waited for those pennies to be in your pocket. But again, is it worth it sometimes to just take that position off the table for what it's worth, knowing that the moment you close it, you're no longer subject to assignment? The way I tend to think about, especially short options, is the analogy I tend to think in my mind is that if imagine someone handed you just a wet towel and told you to dry it out, well, you'd wring it out, but it can only be made so dry until enough time passes. And sometimes, say an option you sold for $1 and it's going for 5, 6 cents, is it worth it for you to just close that out, take your profits, move on to the next trade, not have to worry about something crazy happening between now and the end of the day? And then how do you close a trade? Again, it's very easy to remember that essentially we just do the opposite of what we did to open the trade. If we bought to open the position, we sell to close. If we sold to open, then we have to buy it to close. We have to do the inverse of what we did originally to close out of that position. No, I've been going for a bit on the management side. Anything you wanted to add, Albert? Any other components that we want to make sure we consider?
Yeah, there was actually a question about setting up an auto exit plan or stop loss, things like that. And I wanted to address that because I think that's a really good question. And we touched on this early, I think, in the first week, and that is that when you're trading these options, liquidity is a huge part of trading options. And let me show you what I'm talking about because I think that we can kind of walk through this exercise to give you a better understanding. Because the answer is yes, you can. The question is it the right thing to do at times? So let's take a look real quick. Here I've pulled up Fidelity Trader Plus, and I've got the SPY option chain. The reason I chose that is because it's very active. We know it's very active. It trades millions of shares every single day. And if we were to look at any one of the SPY options for April 17th, well, relatively tight for the most part. I mean, you can see 5 cents, 4 cents, 3 cents. It's relatively tight with regards to the spread between the bid and the ask. So, why is that important? Well, it's important because if you're going to use something like a stop loss or to keep you out of your trade or get you out when the thing moves, you'd want to make sure that there's liquidity to support that because remember what a stop loss does. A stop loss, once triggered, turns into a market order. The last thing you'd want to see is get triggered and then get filled way far away from the actual price you thought you were going to get. Now, if the bid-ask spread is relatively close, we might get triggered, at 82, but get filled at 79. That's the amount of slippage we're talking about when we get to something like this that is relatively actively traded. So in that essence, if you're trading SPY options, could you set a stop loss? Theoretically, you could, yes. But just remember what that order does and understand what you might get back in return. Now, let's try another tack. Let's go over to the actual website itself. I'm on the stock research page, and I'm going to go over here to the screener tools, and I'm going to hit start a stock screen because this will be a good illustration as to what we might want to think about when we're trying to use these types of orders. So I'm going to do a real simple one, and I'm going to say, just show me, oops, not that. Let me clear that. Show me the stocks within the S&P. No, actually, let's go NASDAQ 100, right? Just to give us a small list to start with. And of course, show me stocks that are optionable. All right, so now they're all optionable. And then finally, show me the volume, the average volume over the last 90 days. All right. So now we've got our list of the NASDAQ 100 stocks. We've got a list of the volume, and I'm going to sort this first by most to least. So you're going to see some very familiar names at the top, right? Apple, Nvidia, Tesla, Netflix, right? They're all right here at the top. They trade millions of shares a day. Great. No problem there. And that probably reflects in the options. What if we reverse sort this? If we reverse sort this, it's a little bit of a different story. And yes, I understand Bookings has a massive share price, but even if we scroll down the list to the first thing that maybe is under $100, here we go. CCEP, Coca-Cola Euro Pacific Partners, PLC, right? CCEP. It's a member of the NASDAQ 100. It trades 1.7 million shares. It's right around $93. What does that option chain look like? So let's go back and let's see what it looks like. All right. CCEP. Here's our CCEP. There's April 17th. What does this liquidity look like? 40 cents spread between the 100 call, which is $7 away, $2 away. We still have over 30 cents spread in between that particular. And look, there's no volume. There's only volume on one contract, and that's the 95 put. So this is the point I was hoping to make. Look at this one, $2.20 spread. This is the point I was trying to make. If you're going to use those advanced type of orders, such as stop losses and things of that nature, yes, you can, but I would caution you to make sure that the liquidity there is to support that type of trade. If you have spreads that are 2, 3, 4 cents wide, I would say that you could probably get away with that. But understand what that trade does, right? It's going to turn into a market order, and so you could get filled a bit lower than or a bit higher, depending on what it is that you're trying to do, than where you put it in. The other side of the coin is this. If you put in a stop loss and it's triggered because the offer goes to 90 cents, what's going to happen? You're going to get filled on the bid side at 50 cents. That's 40 cents away from where you had that trigger set at. So I would ask you, is that acceptable to you? Because to me, that's a massive difference between what you think you're going to get and what you actually get. So hopefully that answers the question. Yes, you can, but there are caveats to that. There are things that we need to think about before we do that. Is that really what we want? What is that trade going to do? if we do that? And how do I feel about that situation? The other side of the coin is, what if you set up a limit order, right? A stop limit. What is your limit? What if it's triggered at 90 and your limit's 80 and the next thing that trades is 50 cents? You've got nothing there and it could gap down and not trade at all and it just could move lower. So remember, the stop limit guarantees your price, but it absolutely does not guarantee you a fill. So hopefully that makes sense on the option or the order types. Um, if we're dealing with things that are relatively liquid, then it's not as big of an issue as long as we understand what those orders do. But if we start getting into options that are much less liquid or have much larger bid-ask spreads, then we have to be a little bit more careful with those types of orders. Andrew, before we move on to anything else, anything you want to add to that? 'Cause I know this is a topic that comes up all the time about option and options trading.
Yeah, when we think about liquidity, there's no exact black or white rule to determine what ultimately is liquid. When we think about it in this case, the way I like to just put pen to paper on how I determine it is I just ask myself, if I accidentally placed the wrong trade here and needed to get out of it, how much haircut would I have to take? In this case, if I originally was trying to buy the 90 strike calls and I accidentally, bought or sold the other side of it, what would it take in this case? Or imagine a scenario, I think a better example would be, imagine I'm trying to buy a put and I accidentally buy the call. So in this case, I buy the 90 strike calls for 520 and I realize I placed the wrong trade. I need to get out of it right away. Right this moment, I'd have to sell them at 480. So I'd have to take a 40-cent haircut just because I was on the wrong side of that position. Because I fat fingered the trade, I placed the wrong trade. I've now lost 40 cents. So how much is that? I mean, 40 cents might be not the most in the grand scheme of that, but that's a what, 7.5% loss just on placing the wrong trade and getting out of it as quickly as I can. And what does that also mean? It means if I did mean to buy the 90 strikes, and I bought them for 520 at the ask. Now, nothing is stopping you all from maybe trying to get in the midpoint or something or fill. But imagine I did mean to buy the 90 strike calls. I paid 520 for them. Now they're worth 480. The moment it hits my account, the moment it is a position in my account, it is worth $4.80 because that's the current bid. So what does that mean? It needs now to not just go up, it needs to go up more than what the original kind of slippage was in that moment. I need the underlying option that I've traded to move 8% just for me to be above 0%. I'm immediately at an 8% loss due to liquidity, and I need it to move 8% just so I can be in the green. So that to me is just a way of gut checking, is this liquid enough for me? If that is the case, then that's fine. There's nothing that we have to do. If you say that, hey, 8% is enough, that's the cost of doing business, then that's totally fine. Imagine a scenario. I've seen options where, it's a dollar ask 20-cent bid. And in that case, it almost just becomes untradeable in that scenario because we just need so much to happen just to make money on it. And I know a lot of times I've told myself, well, I'm like, hey, it's not that liquid now, but when I need to get out of it, it'll be liquid. And why would that be the case? Why would that ever be the case if it was not liquid when I tried to get in, that it would be liquid on the way out? Now, I have had ones, in essence, that it just did well enough that it created the liquidity, meaning that imagine you buy some call that's so out of the money originally that it's not fairly liquid, but by the time the trade works out, it's in the money or much closer to being in the money. Now maybe some liquidity has come into the mix. It's mostly just coming down and understanding, what do you need to have happen for it to be profitable. If that's the case, then that's what we have to think about. What do we ultimately need for it to be profitable? Sometimes that becomes insurmountable because imagine you buy an option, or you're looking at option as $1 ask 20-cent bid. We need the bid to go up by 5x just to get back to our break-even price if we bought it at the ask. That's sometimes difficult. That sometimes it just necessitates. And maybe that's something that you're factoring in. And again, there's no exact black or white rule. I think it just comes down to asking, what does success look like here? What do I need to have happen for it to be successful? Can I paint a picture? Can I think about a path with which that does happen? Or does that seem just insurmountable to me? And does that negate some of the components? And
maybe that's where sometimes you'll see that maybe trading the shares does make sense. You'll notice this a lot sometimes on very, very low dollar options that, imagine you see an option that is a $1 strike and the underlying is at 80 cents. And then you're thinking, all right, well, $1 is at the money, and the next strike's a $2 strike. And you're like, all right, well, $1 versus 80 cents versus $2 versus 80 cents. That's quite a bit of movement needed in the underlying. And you might see that liquidity dry up in that case. Anything though you wanted to add, Albert, before we wrap up today?
Yeah, the other thing too I'll mention to you is this is because there's more questions about how do you get around the idea of a lightly traded option. Well, the answer is you really don't, because this 50 cents at 90 cents bid ask. This is basically a market maker making this options market. And the reason it's so wide is because remember, they're not in it for a directional bias by any means. They're simply saying, I'll trade this and then I'll hedge it somewhere else or I'll offset it with deltas, blah, blah, blah. So what they're telling you right now by setting it at 50 cents and 90 cents is that this thing is so illiquid that even if I get executed on the bid side or the ask side, for me to make money, it's going to be very difficult for me to get this trade off and to hedge it properly. So if they're having a hard time doing the trade, then you could expect that you're probably going to have a hard time as well. And again, it depends on what your purposes are, right? If you're planning on buying it and just holding it to expiration, you probably don't care as much. But issue becomes when you try to get out of it. Like if we put a limit order to get into a trade, we can wait and let it do what it does about it. But when we're trying to get out of it, we probably have a bit of a sense of urgency at that point, or maybe we've got, potentially a sense of urgency. And so that makes it a little bit different. So that's what I would say about that as a final word. Last thing I'll point out, a lot of questions about paper trading. You can absolutely paper trade any one of these things if you want to. All you have to do is go to Concentrate. You can actually use the trading dashboard here, the web version of Trader Plus, and you can use the watch list. And the nice part about the watch list is you can add a symbol into the watch list and you can watch it and it'll update every single day. In fact, once you actually type in that symbol, it will tell you that your paper trade has been updated. So if I was to look at SPY, just for an example, I know this is not an option, but it's the same for options. The only difference is you just have to put in the symbol of the option. If I put in the quantity, let's say I said, I'm going to buy 100 SPY and my price is going 55. And it'll update for me. It says paper trade data for XLB has been updated. Well, I put in the wrong one. Sorry. Anyway, but it'll track it for you, and it'll do the same thing for options. You just have to put the symbol in. So hopefully that's helpful. Again, easy way to paper trade and get comfortable before you get into the actual trading. Final reminder, again, if you have the ability, we're going to be doing 7 option mistakes to avoid. This is going to be a good one. It's really a great kind of way to wrap up this 4-week session. Thoughts about option trading and what pitfalls to avoid as you move forward. But until next time, hopefully everyone had a good experience here the last 4 weeks. Hopefully you learned a little bit about options trading and feel comfortable going forward. I wish you all the best in your option trading journey. Andrew, as always, a pleasure to share the screen with you, sir. And I hope everyone has a great rest of the day, great rest of their week. We'll see you next time. Take care, everybody.
Likewise, take care, everyone.